Hello everyone, this is our first video on the Bittan brief with Alexander Bittan. I am your host Alexander, and in this video we are going to be diving deep into Google stock, ticker GOOG GOOGL. This is a brand new YouTube channel, so if you're into the stock market, if you like doing deep dives into different stocks, make sure to give us a subscribe and make sure to put a thumbs up and like the video so we can get this channel off on the right start. Now let's dive into Google stock. Alphabet stock is trading at around $154 a share at the time of this recording. That's down about 18.5% year to date. We are about $52 cheaper than it was at the start of February, which will bring us a little over around $206, $207 a share. To me, this represents an incredible discount and a really good deal on the stock. And let's dive a little bit into why I think that. So we're going to first look at the price to earnings ratio, the PE of this company. Over the last 4 to 5 years, this company has kind of hovered around an average, I'd say, PE of around 25. It has peaked above 35, maybe 37, 38 range in 2020, and it's currently trading under 20 times earnings. So it's trading about 19 times earnings right now, which is around the low. Last time we saw that in like January 2023, it was around 19 times earnings. It pretty quickly started to come up and go back to the 25 to 30 range in its multiple. So I do think this is a pretty low multiple for such a great company. And when we compare it to the rest of big tech, you'll see that it is trading at a discount compared to the rest of big tech on a PE basis. So on this chart here, you can see that Google's PE, like we said, is 19 times earnings. And if you compare that to the other big tech companies, Apple's got a 35 PE, Amazon trading above that, maybe 36, 37 PE. We see Microsoft at a 30 PE, Nvidia at a 37 PE. Only Meta is trading at a similar PE, and even Meta at 24.17 PE. So, Alphabet is the only one under a 20 PE. And when we swap it over to a forward basis, so next year's earnings, Alphabet is trading at a forward PE of 17. I mean, this is ridiculously low. Even the next lowest one out of these big tech names is Meta, and that's still above 20. It's 22.75, so closer to 23 PE. All the rest of the big tech names, 24, 27, 28, 30 times forward earnings. Giving Alphabet a forward PE of 17 is just straight disrespectful. So you might be wondering, how do they stack up when it comes to revenue or revenue growth, for example? Well, if you look at this chart of those same exact names that are trading at much higher PEs right now, Google is the third largest company in terms of revenue. The only higher revenue companies are Amazon and Apple. And then Google comes third, after Google, Microsoft, after Microsoft, Meta, and then Nvidia on the bottom. Now, if you're looking at like how fast is their revenue even growing, well, the two companies that have higher revenue are not growing their revenue at a faster clip than Google. Google's got a CAGR of 17.7% revenue growth from 2020 through 2024. If you compare that, Apple's revenue growth has grown in that same time frame, 9.2% on average each year compounding. Amazon, 13.4%. So at 17.7%, that is a lot higher. Now, if you compare it to the rest of the companies, Microsoft, 14.4%, Meta, 17.6%, what we see is actually Google has the highest revenue growth in this time frame, except for Nvidia. But Nvidia, obviously insane CAGR, 67.2% revenue growth rate in this time frame, but it's starting from a much lower base. We're talking about starting in 2020 at 16.6 billion in revenue for the year, compared to Google, which started at 182 billion. So when you're comparing the companies that were basically at $100+ billion starting run rate, Google has the highest growth rate of all of them, yet it's trading at the lowest multiple. So now let's just dive deeper into Google itself and its revenue. If you look here from 2015 through the end of 2024, when we're doing estimates for 2025 and 2026, these are analyst estimates, to be clear, so it's what they are expected to do in revenue. Look at this. Does this look like a falling or a bad business in any way? This revenue has grown from 74.9 billion and in 2024, 350 billion of revenue. Massive growth. Again, compounding at 17.7% over a 10-year time frame. when we look at their net income as well has been just steadily going up, CAGRing at 20% on a 10-year time frame, and it's continuously expected to go up from $100 billion in 2024 to $123 billion in 2026 as the estimate. So it's clear this is not a failing or dying business in any way. This is a business that is continuing to grow at a high growth rate and is doing extremely well. Now, I'd like to show this chart, which is showing on one hand the shares outstanding, which is coming down basically since around 2018 forward. Their shares have been coming down, total shares outstanding for the company. And this is because they've been buying back shares aggressively. And their EPS, on the other hand, how quarter by quarter, year by year, this EPS has been growing. We see it's at $8.10 for 2024, expected to continue to grow. And that's a huge jump from just a year ago being over around $5. So EPS continues to grow, share count continues to go down. So next, some might argue, well, the core business is in trouble. What about ChatGPT? What about these things? Well, let's just take a look into their core business. Forget about the cloud and YouTube and other things. Let's look at Google search, Google networks, Google subscriptions. Here's their core business from 2020 through 2024. It has went from $148.8 billion revenue to $268.7 billion. Does this look like a business that is in trouble or having any issue? The core search business has went from $104 billion to $198 billion, almost doubling from 2020 through 2024. Even from 1 year ago, from 175 to almost 200 billion, this business is growing. Now, let's look into Google Cloud, which was not included there, because this is a high growing business that's on the up and coming for them, making them a lot of profits right now. This went from 13 billion in 2020 to 43.2 billion in 2024. This is insane growth. We're talking about 35% CAGR from 2020 through 2024. So their growth is just growing like crazy in the cloud business. It is the fastest growing cloud business, actually. And if we look at the income for that business line, this was a business that just in 2020 was losing them $5.6 billion to now gaining a net income of $6.1 billion of operating income for the cloud segment alone. So what we can see from this was, as they basically have went through all the fixed costs of running this operation, the margins are incredibly high. So as they have more revenue, most of that revenue is just dropping to the bottom line. And that's why we saw this spike. In 2023, they had passed basically profitability, got to 1.7 billion, and they quickly went from 1.7 billion to 6.1 billion for the next year, a rise of over $4 billion. And that's coming from less than an additional $10 billion of revenue. This margin expansion is going to continue. We're going to see a ton of income dropping to the bottom line for the Google Cloud segment. This is an extremely profitable business as it's scaled, and they have every intention to scale it, which we're going to get into a little bit later. But if you look at Amazon, for example, all their profits are coming from AWS, their cloud segment. I mean, the rest of the main operation where most people use Amazon.com for is actually a money-losing business for the most part. It's really their cloud that's made them all their profit, and Google has the fastest growing cloud business of all cloud businesses right now. It is number 3 under AWS and Azure from Microsoft, but it's catching up and growing very quickly. The next revenue segment we're going to talk about is YouTube. That was not included as well before. YouTube is a growing business that went from in 2020 being a $19.7 billion revenue run rate to $36.1 billion, almost $40 billion business from YouTube alone. This one has had a 16.3% CAGR, so that's compounded annual growth rate. Just to be clear, if anyone doesn't know what CAGR is, it's compounded annual growth rate going from 2020 through 2024. So their revenue is growing at 16.3% per year so far. This is a fast growing business, incredible business in YouTube. And one of my favorite things about this business is, instead of paying for the content like a Netflix or Disney would have to do, the content comes from users. It's user-generated content, so they just pay the users based on how it performs because they split the ad revenue. This is incredible high-margin business for them. Now I want to get into the stock buybacks that Google's been doing. If you look here from 2015 through 2024, they've just been increasing their stock buybacks because this company is printing cash more than they know what to do with. So they've just been pumping it into buying their shares back. So as a shareholder, this brings the share count down, and basically your ownership per share just becomes a larger and larger piece of the pie when you own the stock, because they are just buying back their company's shares, making each share worth more, a larger slice of the pie. Now, just to be clear, even with these massive stock buybacks, this company is sitting on a treasure chest of cash. We're talking about basically $100 billion in cash and short-term investments. So if you're looking for a balance sheet that is a fortress and cash printing machine when it comes to their net income, you really have nothing to complain about when you look at Alphabet. $100 billion sitting in cash ready to be deployed into anything they want to do, with another 25 plus billion coming every quarter. I mean, that's after all expenses, after R&D and whatnot. It's one of the reasons they're able to acquire Wiz, which is recently announced. So if you don't know yet, Google has made a $32 billion acquisition of Wiz, which is a cloud security, cybersecurity, and multi-cloud company in the AI era that they're trying to basically enhance their cloud offering. We talked about how fast that business is growing for them. We talked about how profitable the cloud sector is for them. And now they're about to supercharge that with this cybersecurity offering. And they also have some expertise with multi-cloud that's going to help their offering as well. Now, it's probably important to put into perspective how big of an acquisition this is for the company, because this is their largest acquisition. Now, their next largest after $32 billion was Motorola Mobility in 2012 at $12.5 billion. Now, that ended up getting sold for $2.9 billion later, so probably a failed acquisition there. That said, who knows what they learned when they acquired it and how that helped them with Android and whatnot. But beyond that, I mean, the next biggest acquisition was $5.4 billion. Mandiant, that's also a cybersecurity firm. Then we had Nest Labs, that's obviously a big one in terms of brand awareness and whatnot for their products. You have DoubleClick, which is huge for their advertising. That was a $3.1 billion acquisition. Fitbit, $2.1 billion. YouTube was only $1.65 billion, probably one of the best acquisitions of all time, if not the best. And basically the point is a lot of acquisitions under $1 billion, but $32 billion is by far the largest. So was it too much? What kind of deal was this? Should they have done it? Well, let's just start with Wiz rejected a $23 billion takeover offer from Alphabet just in July last year. So, we're talking about 9 months ago. They offered $23 billion to buy this company, and Wiz rejected it. You don't deny $23 billion if you don't have the goods. I mean, this company knew what they had, and they stuck with their guns, and they kept it. People talk about things like how hard it was to turn down maybe $3 billion from Zuckerberg when Evan Spiegel, the founder of Snapchat, turned that deal away. I mean, imagine turning $23 billion away from Google. I mean, it's just unheard of. So although this is an expensive deal, the fact that they were willing to reject $23 billion offer tells me that the company and their team was extremely confident in the future of this business and the product that they had to offer. Otherwise, they would have taken the deal 9 months ago. So I feel a little more confident spending this kind of money for this company, knowing it's about 1.5 quarters of net income. So, if you go 4 or 5 months out of net income for Google, you basically got this company for free if you're willing to accept those 5 months of net income going towards this. So when you have $100 billion in cash like they do, and you do an all-cash deal at $32 billion, it's kind of like, instead of just making interest on your cash, you have this long future of growth ahead indefinitely for this product and how much it can do for this massive cloud business, this $40 billion and growing business. It's going to help them round out that product offering with cybersecurity and multi-cloud, etc. So I'm actually a fan of the deal long term. What we do want is growth. We do want them investing. I don't want a stagnant company. Now, talking about investing and acquisitions and whatnot, they also invested around $3 billion in Anthropic, the people who create Claude. This is a $3 billion for 14% stake in the company. It was done in multiple rounds. So $2 billion was committed apparently in 2023 and $1 billion extra in early 2025. Amazon's invested in this company. Alphabet's clearly an investor. So Alphabet has their Gemini AI products. They're a competitor with Anthropic, but they also own 14% of this company. So they are not just competing, but they are also investing in their competition. So one of the biggest critiques that people say about Google is that there's a danger of losing their business, their search business, because of AI. The chat GPTs, the OpenAI of this world could take that business from them, and people won't be using Google to search, and they're going to be using these LLMs, and their business is in risk, and that's why maybe you should stay away. Well, if you're worried about AI ruining their business, let's look at AI. Let's look at how Google is in the AI world. It would be silly to mention AI and not bring up DeepMind. Google has DeepMind. They're basically AI brain for the company. DeepMind is a leader in AI. They've recently talked about Gemini 2.5, their LLM. They've talked about Gemini robotics, image generation. Across the board, DeepMind, if you look into DeepMind, if you watch the documentaries on DeepMind, AI is basically at their core for Google. So let's talk about robotics. Recently, Gemini Robotics was released by Google. This is bringing AI to the physical world with robots. Humanoid robots have been basically the craze, but all types of robots. It doesn't have to be humanoid robots to use Gemini Robotics, which is basically the brain that's going to be doing all the functions for anyone's hardware that basically wants to plug in Gemini Robotics into it. If you have not seen this video and you're interested in Google's robotics, look up Gemini Robotics bringing AI to the physical world on YouTube. Watch that video and tell me that they aren't building incredible real-world AI. Now, what about physical humanoid robots, which have been a huge craze? Google joins a $350 million funding round for Apptronic, a humanoid robot company, just to show you that they are investing in AI. They are investing in the future. They're investing not only in the software and the brain, but they're actually investing in the company, the hardware for other companies. They're, I'm sure, building lots of things in-house that they don't talk about, but even outside of the company, they're putting their money, their cash, into lots of companies that have to do with AI. Now let's talk about Gemini and their own AI projects, because Gemini, this is the age of artificial intelligence for the company. These are large language models, and what they really specialize in is multimodal, which means it's not just putting in text prompts. It's voice, it's pictures, and it's video as well. This is extremely important because the world we live in is not just a chat text box. It has physical images, which is going to come into play with future hardware, things like think glasses. So being able to be multimodal is extremely important and a huge advantage for Gemini. Now, all of this AI runs on GPUs, TPUs, these things, basically massive data centers to train it and then for inference as well. Well, Google knows a thing or two about data centers. This company has been building data centers way before AI was a hot topic. Google makes use of these data centers also for multiple business lines. So, for example, they can have these data centers for their cloud businesses, so they can be renting out space for their cloud customers, and they also can be using it for training and whatnot for themselves and their own AI. So they have optionality with their data centers as well. Now let's get into the chips that are used for AI. Well, there's something called a TPU. The Trillium is the newest chip. It's the 6th generation TPU. A TPU is a specialized custom designed processor from Google, optimized for TensorFlow and large-scale AI tasks. This is a chip that is specifically designed for AI. So while everyone is using GPUs, and NVIDIA is incredible, nothing against them, including Alphabet, they use tons of GPUs from NVIDIA, but these GPUs are general purpose processors used for many things. Now, of course, they are great for training, and everyone is using them, and NVIDIA has done an incredible job building the ecosystem and software around their chips. But that said, Google is also building their own in-house chips to compete. A lot of people know Dojo from Tesla. think of Google's TPUs similar to that. Not that they are doing the exact same thing as Dojo, but that they are basically purpose-built chips for AI and for specifically what they're trying to do with Google and their AI projects, whereas Dojo is specifically built for training video, for self-driving for Tesla and what they're trying to do. So Tesla is doing with Dojo what Google does with its TPUs for themselves. Both are trying to basically not rely on NVIDIA as much. So Alphabet's building the hardware, they're building software. Now let's talk about some of their projects in AI. Project Astra, basically a perfect example of AI use case in the real world. So this is something on their phone as well as glasses. I think ultimately long-term will mainly be a product for glasses, because what it is multimodal AI. So imagine you're wearing the glasses, it has memory of things, it has real-time conversations the same way LLMs do, has plenty of tools built in. So one of the demos they show is someone's walking around the room, they pass a certain object, they're no longer looking at that object, it's not in their view, and then they basically ask the AI glasses, hey, do you remember where I left the X, Y, and Z? And the glasses, because it's able to pull back the memory of everything it had seen prior, it tells the person doing the demo exactly where it was on the desk next to X, Y, and Z, and the person goes and gets it. So the bottom line is it is AI for the real world, not only taking your voice into account, but also taking cameras and what it sees, real-time video into account, and having a memory built into that as well. So you cannot be building this out if you are not competent in artificial intelligence. Now, beyond computing as we know it will be quantum computing. And Alphabet's a leader in quantum computing. They introduced Willow, their next generation of quantum chips, not too long ago, earlier this year, and it has some breakthrough technology, and they talk all about that, and you can do your research into Willow and Google's quantum computing. But the point to show here is not to dive deep into when it's going to materialize and be commercial or any of that, but it's to show that Alphabet is working on future growth prospects far beyond what's practical today. Now, another massive business in the world of artificial intelligence that Alphabet has its hands in is self-driving. So obviously Alphabet created Waymo. Waymo is a autonomous robo-taxi network that they have built. The Waymo One app competes with Uber. They're actually also on the Uber app in some markets, and they're expanding this to many more markets. So I personally used Waymo recently in San Francisco. It was an incredible experience. I way prefer it than taking a regular Uber. Nobody in the car with you. I mean, it's amazing. It's private. You can be talking to your friend loudly without having someone listening into your conversations. It's safer, in my opinion, in terms of how cautious it is, as well as just simply the fact of not getting in the car with strangers for young people. And this is a live and operational business, to be clear. This isn't just some future prospect. They're currently operating in Phoenix, Los Angeles, San Francisco, and Austin, and they're coming soon to Atlanta, Miami, Washington, D.C., and Tokyo. So international expansion as well. Now, I know many people are going to basically say, well, Tesla's going to destroy them, or Tesla's going to, self-driving cars and whatnot. I have a Tesla. I love FSD. But it is important to note the difference in the fact that this is currently operational robotaxi. Tesla has been saying they're going to do it forever. I have no doubt Elon will eventually be doing it and be competing in this business. But currently, Waymo has 200,000 paid rides per week. So you just can't argue with these numbers. And these numbers are growing very fast. So we will see what Tesla ends up doing in the robotaxi network and robotaxi business. But in the meantime, Alphabet, this is a small part of their business, but they have their hands in it. Like many things, they have their hands in a ton of businesses. So where is Waymo represented in their income and their revenue? It's represented in their other bets category, which has went in 2020 from $657 million revenue business to $1.6 billion. So we're talking about a 25.8% revenue CAGR, and this includes lots of other businesses as well. So it is a growing business. We're going to see how that continues to expand. Now, there are tons of other businesses that most people probably have never heard of that are under the Alphabet umbrella. Think Verily. This is an AI health company owned by Alphabet. And recently, they've underwent some restructuring because they want to separate from Google's infrastructure. And it's basically because they want to at least rumors are, potentially IPO spin off of Alphabet into their own company. So that's a win for Google, because that takes this Other Bets company, some health AI company, and actually turns it into something that is going to be recognized, whether they sell their shares, whether they're holding on to them and they're publicly traded and other investors come in, whatever it is. The point is, there are so many things like this that basically you get access to when you own Google stock. So the company is far more than just a search business. Now, Google's also obviously competing in the home. In January 2014, Google acquired Nest Labs, smart thermostats, smart smoke detectors, things like that. $3.2 billion acquisition. What else did Google do? Extremely smart of them. They invested $450 million to acquire 6.6% ownership in ADT, the security company. What do? They made a partnership with ADT. They're an investor in the company, so you own a piece of ADT, and they put Nest products with ADT's system. So ADT can put Nest cameras around your house, and basically you can use the Google Home basically to see your cameras in the house. And ADT basically promotes these products in partnership with Google. So Google is making hardware for the home, security systems for the home, and owns a piece of the biggest basically home security company in ADT. Now, you can't talk about Google and not bring up the fact that they own Android, the largest operating system in the world. Personally, I'm an iOS person. I use iPhone, I use Mac. But as of 2025, you can't lie with the numbers. I mean, market share is 71.88%, over 3.3 billion active users on Android. And when we look, a lot of people say, oh, it's just people outside of the US. The US is really run by Apple. Well, even in the US, Android holds 42.34% market share in the US mobile operating system market. That's massive. I didn't even know it was that high in the US. I always knew it was the leader globally, but in the US, 42%, that's extremely impressive. And Alphabet doesn't just want to control the operating system, they also want to control hardware. Just like Apple, they want to make hardware. They have their Pixel lineup, they have folding phones, they're innovating. How many years has the iPhone looked the same? Of course, I love my iPhone, but I'm not going to lie, when they come out with these folding devices, I wish it had Apple's iOS and that Apple's entire moat of things like Apple Pay and iMessage was available, because I'd rather that hardware. I want a folding phone that I can open up and basically have a tablet. So they're competing on hardware. Then you take Android into the car. This is now future type of things. Car operating systems are horrible. If you're not in a Tesla or a Rivian, basically, your operating system in the car is just really bad. I mean, you can buy a $100,000 Mercedes and just have horrible operating system that just works terribly. So Apple and Android are tackling this. Google is doing it with Android Auto, basically bringing, smart operating system to the automobile, which is good for them and their partnerships with cars. And obviously, I think we're going to see a lot more of that in the future. Now, there's one huge Android product that really hasn't taken off till recently. It's been announced, but it hasn't taken off because this is the future of Android, and that's Android XR. This is something recently announced. It's their platform that's going to live alongside mobile, TV, and auto, which is going to be extending into augmented reality, AI-powered headsets and glasses. So this is going to blend the digital and physical world. Think about smart glasses in the future. People have spoke for a long time about smart glasses possibly being the next major computing platform beyond the smartphone. And Alphabet plans to be in that race, plans to have Android as an operating system in the future platforms of the world. So I'm very excited to see what Android XR comes out with and what happens with hardware there. Now I want to talk about venture. There's Google Ventures, there's Capital G. Basically, when you're owning Alphabet stock, they have these venture arms that invest in the future companies, the next big thing. So think Uber, Stripe, Slack, Lyft, all these companies, Duolingo, plenty of companies that basically on the early days got investments from Google's venture arms, and some companies got acquired by Google, like Nest, that they invested in early days, and then they ended up acquiring them. Other companies IPO'd, and Alphabet, can sell the shares if they want or hold them. And then there's other companies that are still private, and Alphabet just owns them through these venture arms. To me, this is a massive advantage that you're getting by owning Alphabet stock that you don't really get in, other companies than big tech. Like Apple, for example, very rarely invests in other companies. So having these venture arms is giving you exposure to early days in huge possible companies of the future. Okay, so let's sum this all up. It's safe to say that when you're buying Alphabet stock, Google, it gives you exposure to a ton of industries and a ton of different businesses. And this company has its hands in so much more than just search. It's clearly investing heavily in AI as well. So, what is there not to like about this stock? It's competing on multiple fronts against the rest of big tech. Think about it. It has a bigger ads business than Meta. In Q4 2024, Google's advertising was $72.4 billion of their revenue. Well, Meta's in Q4, their ad revenue was $46.8 billion. So you have a larger ads business than Meta. You got a bigger market share in your operating system than Apple with Android. You got more streaming viewership in YouTube than Netflix. And you got a faster growing cloud business than Amazon or Microsoft. Google Cloud at 30% year over year growth, whereas AWS was at 19%, Microsoft in their most recent Q4, 19%. So you have Waymo in robo-taxis competing against Tesla. You have TPU chips and quantum chips competing against NVIDIA. So basically, Alphabet is competing against all the rest of big tech. They are not just single-handedly in one thing. Now, they may not be best at any individual category, although you could easily argue that they are best when it comes to ads or when it comes to streaming. That all said, they are top players in so many different categories, which is what makes them so impressive. So let's just get into what this stock should be worth. So back to that stock price. Well, there's 46 analysts that put estimates on Google with an EPS of $10.25 in 2026. That's the average estimate. With a 24 times PE, which is what I think is their standard average PE and a fair PE for the company, the way they're growing and their future prospects, you get a $246 share price. That's a 24 multiple on the $10.25 of EPS expected in 2026. Well, at today's price of $154 a share, this is representing around 60% upside to my personal price target. I also don't think that the future is going to be less favorable to Alphabet. I actually think with AI, cloud, streaming, augmented reality, I think the future is going to represent tons of growth ahead and be extremely favorable to this company. And you pair that growth with the steady buybacks they're doing, and you also talk about future acquisitions they're going to do with all this cash they have, the additional businesses they're going to own through that. I just think this stock is a no-brainer to own here at these levels. So again, this is the first video for the Bittan Brief. I'm your host, Alexander Bittan. If you enjoyed this video and you want to see more deep dives in other stocks, make sure to like this video and subscribe to the channel. Until next time, guys.